the stock market is going crazy, breaking records, but something feels off. It's like a puzzle. And that's what we're going to try to figure out today with Jeremy Grantham, a really famous investor in his company GMO. Grantham started GMO way back in 1977, and he's known for going against the grain in investing and being able to spot market bubbles. Back in 2015, GMO was managing $118 billion in assets. So they know what they're doing. Their whole philosophy revolves around this idea called reversion to the mean. Basically, what that means is that no matter how high or low prices get there, they always swing back to their historical averages. Think of it like a rubber band. You can stretch it out, but eventually it snaps back. That's how GMO makes predictions about the market looking 7 years ahead. They look at tons of historical data to find anything that's out of whack and use that to guide their investments. And Grantham has got a pretty impressive track record. I mean, he saw the Japanese asset bubble coming in the late 80s. He avoided the dot-com bubble in the 90s, and he even minimized his exposure to the housing bubble in the mid-2000s. He's not your average investor, that's for sure.
Now, fast forward to 2008. Grantham was really critical of how the financial system handled the credit crisis. He said it was a lack of foresight and competence, and blamed the authorities for ignoring all the risky behavior and the growing asset bubbles. He said the signs were there, but nobody wanted to see them. But here's where things get really interesting. March 2024, the U.S. stock market is hitting record highs, but all the global economic indicators are pointing towards trouble. It's like a weird contradiction, and Grantham calls it the Great Paradox. His perspective might help us understand what's going on with this strange market behavior. So let's dig into this paradox together and look at GMO's take on the U.S. and global markets. We'll see where Grantham thinks the opportunities are in this crazy environment and face those big long-term problems that are looming on the horizon. Now, Grantham talks about something called superbubbles. He says markets don't just have regular bubbles, they have these massive ones, these superbubbles. He defines them as times when the market goes 2.5 standard deviations above its historical trend. Statistically, that's huge. And according to Grantham, the U.S. has seen 3 of these superbubbles in modern history in 1929, in 2000, and more recently in 2021. Yeah, that recent craziness in the market. Grantham thinks it's a classic superbubble. He even throws 1972 in there as an honorary member of the Superbubble Club. Even though it wasn't as big on paper, the market dropped a significant 62% in real terms after it burst. The thing about superbubbles is they always pop, and the higher they go, the further they fall. Grantham says there's a pattern to how these superbubbles play out. First, you have the bubble forming all hyped up and driven by irrational exuberance. Then there's a setback, some little tremor in the economy or politics that makes investors pause and think, like a reality check, a moment of doubt. Then you get the bear market rally, where investors are lured back in by lower prices. They think everything's on sale. But Grantham says these rallies are tricky. They're fueled by short-term thinking and a false sense of security. And then comes the grand finale. The fundamentals fall apart and the market crashes. That's the painful part. The bubble pops, and investors are left holding the bag.
Now let's go back to that bear market rally for a second. Grantham points out that within superbubbles, these rallies tend to be fast and furious. Why? Because investors get fixated on those previous high prices. They think a stock that was worth $100 must be a bargain at $50. They lose sight of the big picture. And history backs this up. Look at the crash in 1929. Between November 1929 and April 1930, the market rallied 46%, recovering 55% of its losses from the peak. Same thing happened in 1973. The summer rally after the initial drop recovered 59% of the S&P 500's losses. It's a recurring theme. Even a dot-com bubble followed this script. In 2000, the NASDAQ, which was at the heart of the tech craze, bounced back 60% of its initial losses in just 2 months. And guess what? In 2022, the S&P 500 had regained 58% of its losses from its June low peaking on August 16th. Sound familiar? Grantham says these bear market rallies happen because economic data lags behind. Numbers like corporate profits and employment figures, they don't show the changes in the economy right away. It takes time for them to catch up. And it's during this lag, this period of uncertainty, that these rallies take hold.
Investors see the old data and think, hey, things aren't that bad. But the truth is the fundamentals are already starting to crumble. So why are these superbubbles often followed by economic turmoil? Grantham has a theory. He thinks they tend to happen after long periods of economic growth and market euphoria. By the time the bubble peaks, the economy looks fantastic, full employment, strong GDP growth, low inflation, record profits. But it's a mirage. This is what happened in 1929 and 1972 and 1999, and even in Japan, which had its own epic superbubble in the late 80s. The problem is, when everything looks this good, there's only one way for things to go down. GMO has this model they call the explaining PE model. It helps explain how these different factors work together. It doesn't try to justify market prices, but it shows the financial inputs that have historically explained price-to-earnings ratios. According to this model, the first drop in the current superbubble was driven by rising inflation. And you might be thinking, wait a minute, inflation went up in 2021, but the market kept climbing.
But Grantham thinks this was an exception, maybe because of new investors who'd never seen inflation before, or maybe because people had too much faith in the Fed's ability to control it. Whatever reason, the gap between inflation and valuations was unusual. GMO predicts that the next stage of this market correction will be driven by falling profit margins. They think the explained PE ratio will drop towards 15 from its current level of just under 20. And remember, the actual PE ratio jumped from 30 to 34 in mid-August during that bear market rally. So there's a lot of room for things to fall. And here's the thing, if the model's right and falling profit margins are the next domino to fall, then not only will the PE ratio go down, but earnings themselves will also decrease. That means the market could fall even further than GMO is predicting. Now, in his papers, Waiting for the Last Dance and Let the Wild Rumpus Begin, Grantham makes a simple but important point. He says those three super bubbles in the US, 1929, 1972, and 2000, were all marked by crazy investor behavior and those sky-high valuations. But he didn't really go into the underlying economic fundamentals except to say that he expected some deterioration.
And here we are, we've seen the first stage of the bubble bursting in that big bear market rally. And the economic fundamentals look worse than anyone expected. It's like the world is finally waking up to the fact that this party can't last forever. Inflation is eating away at our purchasing power, and geopolitical tensions are causing disruptions all over the place. And those are just the short-term problems. The long-term challenges, things like demographics, resource scarcity, and climate change, they're getting worse. So let's talk about those short-term problems. First up, we've got the food, energy, and fertilizer crisis. The war in Ukraine has made a bad situation even worse, especially in emerging markets. Think about this. Russia and Belarus account for a whopping 40% of global potash exports. Potash is a key ingredient in fertilizer, and disruptions to its supply have sent prices for wheat, corn, and soybeans through the roof. These rising food and energy prices are causing a lot of pain, particularly in vulnerable countries. We've already seen the Sri Lankan economy practically collapse under this pressure. And the energy shock was pretty much guaranteed to push Europe into a recession.
The U.S. market has often ignored problems overseas, but with global growth slowing down, the impact is bound to be felt eventually. Then there's China, the engine of global growth for the past 3 decades. They're dealing with a whole bunch of challenges right now. The COVID-19 pandemic is still causing problems, and their property market, which is a major driver of their economy, is under immense pressure. Does that sound familiar? It's like the housing bubble, but on a much larger scale. And this weakness in real estate isn't just limited to China. We're seeing it globally, including in the US, where home building is dropping like a rock. Mortgage rates are crazy high, making it impossible for many people to buy a home. And in countries with floating rate mortgages, it's even worse. Remember, real estate has always been a big factor in economic stability. So when it starts to wobble, we should all be paying attention. On top of all that, we're also coming out of one of the biggest fiscal tightenings in history. Governments all over the world are cutting back on those COVID-19 stimulus programs, and this is going to have a ripple effect. Historically, there's been a strong link between fiscal tightening and shrinking profit margins.
It's like a punch in the gut for businesses. And just to add another layer of complexity, the U.S. government has introduced this new tax on stock buybacks. Some people see this as a sign that the government is changing its stance on the whole labor versus capital thing, a battle that capital has been winning for decades. This could lead to more antitrust action, which would be good for consumers, but potentially painful for investors. So yeah, the short-term outlook is, to put it mildly, turbulent. Buckle up, folks, because it's about to get even more interesting. Next, we're going to dive into those long-term challenges that are starting to rear their ugly heads. Things are getting real. Stay tuned. Okay, so let's talk about those long-term problems, the ones that seemed far off but are kind of knocking on our door now. Like climate change, for instance, not that long ago was a big debate, but now I think only the most stubborn people deny it's happening. Last year wasn't just the hottest year on record since we started keeping track. It was the hottest by a huge margin. And get this, if you look at the latest data, up to January 31st of this year, we've actually crossed that 1.5 degree C threshold above pre-industrial levels. For those who thought those numbers didn't matter, well, maybe the sheer number of climate-related disasters, each costing over $1 billion, might make them think twice. We're talking floods, droughts, wildfires, you name it. Globally, last year, climate change wiped out over 1% of GDP. That's a pretty big chunk, considering the total global growth was only 2.9%. And as usual, it's the poorer countries that are getting hit the hardest. Think about this. These crazy atmospheric rivers are dumping a whole month's worth of rain in a single day. Just goes on and on. It's like a constant barrage of climate chaos, and it's only getting worse. Even the insurance companies are freaking out. Premiums are going through the roof as they try to deal with the rising costs of all this climate-related damage. And in some places, getting insurance is becoming almost impossible. It's a pretty clear sign that the risks are getting too big to handle. Now let's switch gears and talk about resource limitations. This wasn't a major issue until around the year 2000 when commodity prices started to climb after going down for a whole century.
GMO has this index that tracks 34 different commodities. It dropped from a value of 100 in 1900 all the way down to 30 in 2002. But now it's hovering around 65, and it's even hit 100 3 times since 2002, most recently in 2022. That steady decline we saw for most of the 20th century is over. At best, prices are fluctuating, but with a lot of volatility. Personally, I think commodity prices are going to hit new highs over the next 20 years, especially for essential stuff like copper and nickel cobalt. These are all critical materials for that green economy transition everyone's talking about, and demand is only going to go up. This change is mainly because of China's incredible growth since 1990. It's a wake-up call that the days of cheap and plentiful resources are coming to an end. When you're dealing with finite resources, eventually they start to run out. We're already seeing shortages popping up everywhere, mixed in with the occasional surplus and price drop. That's just how commodities work. But those days of constantly declining prices are gone. And then there's the problem of toxicity. The levels of toxic stuff in our environment are scary high thanks to all the plastics and chemicals we're producing.
Plastics are great because they last forever, but that's also the problem. They don't break down easily, and when they do break down into smaller pieces, they actually become more dangerous. We're finding microplastics and even nanoplastics in our blood, our brains. We're all in the clans, pretty much every living thing on the planet. The creepy part is we don't really know what the long-term health effects of these tiny plastic particles are because we haven't had enough time to study them properly. Not exactly reassuring, is it? The amount of plastic waste is insane. It's estimated to weigh more than all the animals on Earth combined, and it's growing by 500 million tons every year. And get this, the industry is still predicting huge growth in plastic production for the foreseeable future. It's like we're addicted to something that's slowly poisoning us. But wait, it gets even worse. Chemicals are even sneakier than plastics. There's something like 350,000 different chemicals being produced on a massive scale. And most of them haven't been tested for their toxicity in combination with each other. That's how they exist in the real world. And very few have even been tested individually. At least 10,000 of these chemicals are what they call forever chemicals. They have bonds that can't be broken down naturally. They just build up in the environment, and we have no clue what the long-term consequences will be. And a good chunk of these chemicals, not just the forever ones, are endocrine disruptors. That means they mess with our hormones and disrupt the reproductive systems of insects, amphibians, and even mammals, including us. This constant exposure to man-made chemicals is making our environment less and less hospitable to life. We're seeing insect populations collapsing and human fertility rates are going down. It's all connected. When you combine this chemical assault with all the reasons women have for delaying or avoiding having kids, it doesn't paint a very rosy picture for population growth. We're already seeing birth rates declining and shrinking workforces in a lot of developed countries, and this trend is only going to continue. And as the population gets older, we'll see slower economic growth and increased demand for resources. Japan's a good example of what happens when a population starts to shrink.
They've been dealing with population decline for 30 years, and their group of 18-year-olds is now less than half of what it used to be. Now, I have a rule never extrapolate from Japan. Their culture and social contract are unique, but it's still a cautionary tale. The point is, all these long-term challenges are starting to have real-world impacts, and they're going to affect the global economy in a big way. We're seeing it in slower growth rates, rising inflation, and more geopolitical instability. The question is, can we adapt and find solutions before these problems get completely out of control? So let's bring it back to the markets. The big question for investors is, can we take advantage of the more reasonably priced markets outside the U.S. and make some money before all these long-term problems catch up with us? Can we outrun the storm, so to speak? The paradox that worries me is that the U.S. market is priced for perfection with sky-high valuations and record profit margins. But the reality is we're facing a world that's anything but perfect. We've got geopolitical turmoil, rising social unrest, and a whole bunch of environmental and demographic challenges that are starting to bite.
The disconnect between market optimism and real-world risks is honestly pretty alarming. Now, GMO is known for their long-term value-oriented approach to investing. And right now, they're seeing more opportunities outside the U.S. and markets that haven't been caught up in the same speculative frenzy, like emerging market, for example. A lot of emerging market equities, especially those in the value or low-growth categories, are trading at prices that are either fair or even cheaper than usual. They're a stark contrast to those high-growth stocks that have been pushing the U.S. market to new highs. GMO is particularly bullish on Japan. They believe that Japan is making slow but steady progress in improving their corporate governance and economic policies. And they're confident that the yen will eventually get stronger against the dollar, maybe even by as much as 20% or 30%. Interestingly, over the past few months, non-US stocks have started to show some signs of life, even as the US market fueled by the AI craze keeps soaring to new heights. Japan in particular has been doing well. And the truth is, these markets have a lot more room to grow than the US, with significantly less risk when that bubble finally bursts.
Now, for those of you who are brave enough to really dig into these long-term challenges, GMO is putting out a series of 6 papers that examine each issue in detail. I highly recommend checking them out, but be warned, they're not for the faint of heart. You might want to have a strong drink on hand. It's going to be a wild ride. But hey, that's what we do here, right? We explore the big ideas, the uncomfortable truths, and the challenges ahead. Because if we don't understand these issues, we can't hope to solve them. So stay tuned, folks. We've got a lot more to cover. And don't forget to hit that subscribe button so you don't miss a single episode. So where does all this leave us? I mean, we have the U.S. market. It's like it's on a rocket ship, completely ignoring all the warning signs. It's classic irrational exuberance. You're driven by that AI hype and this belief that this time it's different. But as Jeremy Grantham and GMO have shown us time and time again, history tends to repeat itself. Super bubbles, no matter how big they get, they always pop. And when they do, the fallout can be pretty bad. But there's a bright side.
Markets outside the U.S., like emerging markets in Japan, they offer a more balanced, a more realistic investment landscape. They're not immune to global problems, but they're not priced for perfection either. So what's the takeaway here? For me, it's a reminder to stay skeptical, to question everything, and to look beyond the hype. The market doesn't always make sense, and it definitely doesn't always reflect what's really happening in the world. If you're feeling a little uneasy about the U.S. market right now, you're not alone. GMO's advice is to diversify, look for value, and be prepared for a possible market correction. It's not about being negative, it's about being realistic. Remember, knowledge is power. And in times like these, staying informed and thinking for yourself is more important than ever. Well, that wraps up our discussion for today. Thanks for joining me, and don't forget to subscribe for more insights and analysis like this. See you next time.